Mike Tedeschi, Wealth Management Advisor of Perspective Wealth Planning. In this week's market breakdown video, we're going to take a look at the four major U.S. indexes. We're going to spend some time taking a look at the dollar, commodities, emerging markets. What I really want to focus in on today is the speculative behavior in the penny stock arena, and also what smart money has been doing here in the last hour of the day, and historically when we get into a period of time where this happens, it hasn't bode well for us in the future. So we'll jump in and take a look at that here at the end of the video. So let's start with the S&P 500. Guys, not a whole lot additional to add over the last couple of weeks. Our major zone of support is between that 36 and 3400 level. We have a series of higher lows and a series of higher highs. Market has been trending straight up here now since that breakout at that 3600 zone a month or so back. The Nasdaq continues to do the same thing. As you can see, a series of higher lows is put in here and a series of higher highs. So we have that uptrend in play, right? We come in and we take a look at the Russell, which has been extremely strong from its breakout to new all-time highs in November. In fact, it went from the lagger at that point in time to the leadership. We have very clearly higher lows and higher highs, and this has been extremely strong. We're going to talk about that speculation in the mid-cap and small-cap arena later in the video, but it's certainly very apparent that money has been flowing in that risk-on environment of that mid and small caps, especially when we take a look at the Russell chart in and of itself. The Dow, not as strong as the rest, as you can see here. It actually doesn't have higher lows. It has the same low here put in at the beginning of the year as we did last week. It does have higher highs. It is trending slightly up, but it is certainly the weakest of all of the indexes. It's also, in my opinion, the least important of all of the indexes because it's only made up of 30 companies. It doesn't give as good of a picture as the other indexes themselves. But we always want to pay attention to it anyways because those are 30 of the biggest, most important companies. So it is important to continue to pay attention to it. Now, the U.S. dollar, when we talked last week, was right at an important level, and you can see the lines that we have drawn on the chart. You don't take these things off. I was looking for what was going to happen at that 92 zone when we made this bounce up, and we can clearly see that big rejection. Look, we have a series of lower highs and lower lows in on the U.S. dollar. We're watching to see what this does now back in this 89 zone. It calls out and makes a new low. I expect us to go back and test that 88 zone, right? And again, what happens in the U.S. dollar is really, really important when we start talking about commodities. Best looking commodity as of late, probably platinum. Platinum made an incredible run here over the last 4 or 5 days. We had that breakout there at that 1150 zone and about a 13% run up in 3 days versus the other precious metals. Silver has not put in a new high since the gap up. It's going to hold right there at that 27 level. And we know gold really hasn't done much here over the last 6 months. It did hold the important 1775 level on that sell-off last week and is back up over into the mid-1800s, but a very different looking chart for gold and silver than we've got in platinum. Right, we're also taking a look, as always, at copper. Copper has been really strong, right? So the industrial metals have been acting much better than the precious metals, platinum being a combination of both, acting really well as well. But right here, I'm going to back the chart out on copper to a monthly time frame. You can see where we got this level. We talked about that $3.8 level there in on copper. We've been talking about it since all the way back in November as that next zone of potential resistance. And really that zone of resistance kind of comes up into those highest close zones right about into that 3.9. Up over that, you're looking for a run back up to the 2011 highs. So we're still having some really good action there out of copper, which bodes well economically. We take a look in at crude oil, right? We've talked about this many, many times. That breakout at 54 was important. That next zone of resistance right in there around that 59 to 60 zone, and then above that, the high before the the slide last year is right around 65. This has just been a nice trend higher, continuing to run up. here over the last couple of months, really just kind of a straight vertical, move higher there from last November. It has acted well price action wise, i.e. pausing at resistance levels, but bases and then makes another push higher. So kind of expect this to trade sideways here for a little bit under this next resistance zone at 60, and we'll see what it does with that test of 60. The emerging markets continue to act extremely well. Making a new high yesterday there, continuing to push. If we look at our levels, right, we had the sell-off when we saw, we talked about the S&P and all the other indexes in the beginning of this video. The emerging markets pulled right back to that gap support, and that's where it made its bounce from. So it also has that trend of higher lows and higher highs now. So, it has been in a beautiful uptrend really since it broke that 1150 zone, which we talked about a lot last year. So acting extremely well. Now, the split between the smart money and the dumb money is still extremely wide. Dumb money being over 80, smart money still being right around that 20 zone. That's a pretty wide gap. Again, at some point in time, this will close. But look, we've had this basically since last April where that spread has been in play. And it has, of course, just kind of widened over that time, right? Almost had it come back together when we had that little bit of selling last year before we finally made that breakout. This is still, again, historically a very wide spread. And at some point in time, this will correct itself, right? But this is no indication of it has to happen tomorrow, right? This is, again, one of those things that we look at. We know eventually it's going to come back. It's just a question of when. And when we do start to see this gap kind of close, we typically tend to see some sort of decent little selling event that takes place, and it's certainly worth being cognizant of. Now, we start talking about speculative behavior. Let's take a look at penny stocks. The volume inside of penny stocks is the highest in a decade, and it has continued to climb. Look at the interest that we continue to see here over the last few months. It is historic in terms of the speculative surge into the small cap stocks. Another way of looking into speculative behavior is taking a look at the Nasdaq versus the S&P volume ratio. And that is an historic spot right here. By the way, this chart goes all the way back to 1996, so that does include the dot-com bubble in it. We have not seen anything like this in terms of the volume differential between the Nasdaq, which is proxy for risk, versus the S&P 500. Now, one of the ways you can kind of look at what smart money is doing, Bloomberg has the smart money index, and what that's really looking at is what happens in the last hour of the day. The thought process being if buy volume is increasing in the last hour of the day, then the smart money subsequently is buying and holding on to things. When volume is on the sell side at the end of the day, it is said that smart money subsequently is selling into the end of the day. Right? We are seeing a lot of last hour selling as of late, which has pushed the SMI towards its recent lows. And when we look at this in another way, we're actually at the 90 percentile on this. And this is what I really wanted to talk about in this video. This goes back all the way to the 1970s, when we see days where the S&P 500 is in the top 90% of its range and the smart money index is in the bottom 10% of its range, right? That's giving you that dichotomy between retail and institutional money. And when it gets this spread, historically, we have run into some very murky waters. Back in the 70s, we had a big sell-off there, 75, 76, right? We, of course, remember the dot-com bubble where we had that strong sell-off. And we also got this reading in 2005, 2006, and the markets ran for another couple of years before we had that big sell-off. And in 2014 and 2015, markets continued to head higher. In fact, they're still much higher today without really having any of those kind of larger decreases. And, of course, we've got those readings right now. So the question, of course, becomes, again, this is one of those where we have a small sample of data set, so we can't put that much weight on it, but it is very interesting when we have readings that are all kind of near turning points in the overall market. So are we 2014, 2016, and we're going to see that next run up, or are we back towards that dot-com bubble kind of zone? That's what's we have to wait to see. When we look at the selling off in the last hour, right, they're zoomed in here, we got 98. right? We ran for another few years. We had that 2012. We ran for a while. Then we've had this sell-off here. Then we saw it again in 18. We saw it again in 20 as well, right, where we've had that sell-off there when we've got, again, the S&P 500 in the top 90% and the advancer decliner line in the last hour at the bottom 10%. And there's one more way of looking at this data. Take a look at that last data set, but then look at the number of days where this has occurred. And that has led to a zone where we have seen a lot of selling here in the past 7 or 8 years, marking near-term tops. Not the top of the market, but at least a zone in which we have had some sort of issue arise here shortly. This is really, really important. Again, it's one of those things that we don't have a ton of data sets on, but this is a very big dichotomy that is playing out. We are seeing retail traders extremely aggressive in terms of their speculative behavior. We're seeing call volumes is extremely high against historical norms. We're seeing massive differences between the amount of capital that's being put in on the riskier kind of Nasdaq zone versus the S&P 500. Penny stock soaring, right? And we're seeing smart money kind of dump consistently, selling there in that last hour of the day. Eventually, these things will rectify themselves, but this can go on for quite some time. As we've looked at from some of these data points, we could be in 1996, where we've got another 4 years of incredible potential run-up. These, again, are just things to keep in mind. They're not things to look at and go, oh my goodness, I have to change my entire plan. We're going to follow price action for that. That's why we look at that in the beginning of all of these videos. It's just more things to keep in the back of your mind at this time. As always, I hope you guys found this video important, informative. If there's anything that you want to do, reach out to me. I'm Tedeschi at perspectivewealthplanning.com, or you can give me a call, 814-580-9881. Would love to discuss anything with or about the markets with you. As always, I will see you guys next week. Take care.